Let me show you something that might seem impossible. How to pull $219,500 of income in 2026 and pay $0 in federal income tax. Not through some sketchy offshore scheme or aggressive tax shelter. This is completely legal using provisions that Congress specifically built in the tax code for you. The catch? Well, you're going to have to be strategic about your timing and you're going to need to fit a specific profile. So let me walk you through exactly how this works. Here's our scenario. You're 67 years old, married, filing jointly, and let's say you're semi-retired, bringing in $47,500 from part-time work. And let's say your spouse serves on a nonprofit board, earning $11,000 annually. So that's $58,500 in ordinary income between the two of you. You also have a stock portfolio that you've held for over 15 years. Remember those tech stocks you bought back in 2010? Well, they've appreciated quite nicely, and you've been wondering when you should sell them. This year, let's say you decide to sell $161,000 worth of those tech stocks, but your original cost basis in those shares was $62,100. And your long-term capital gain, the part the IRS actually cares about, is $98,900. That $62,100 is simply your own principal coming back to you. It's a return of your original investment, not new income, so it's not taxable. Only the $98,900 gain shows up as income on your tax return. So from the IRS's point of view, the income that actually shows up on your tax return is going to be the $58,500 of ordinary income, and then the $98,900 of the long-term capital gains, totaling $157,400 of income. But in real life, what did you do? You actually pulled $219,500 of cash into your world. The $47,500 for part-time work, the $11,000 from the nonprofit work, and the $161,000 from selling your tech stocks. Now, this is about when most people would assume they're going to be writing a large check to the IRS for taxes. But watch what happens when we actually run the real numbers. So your total income and your adjusted gross income, or AGI, starts at $157,400. Now we're going to go ahead and calculate your total deductions. And this is where the magic starts to happen. Start with the standard deduction for married filing jointly, which will be $32,200. But because you're both over 65, you get an additional standard deduction of $1,650 each. And so that's $3,300 more. So now your total standard deduction is $35,500, dropping your taxable income to $121,900. But then we need to account for a special deduction that many retirees don't even know about yet. And that's going to be the new senior enhanced deduction. In 2026, if you're 65 or older, you'll get an additional $6,000 deduction per person. So for a married couple, that's going to be $12,000 right off the top, as long as your modified adjusted gross income is at or below $150,000. Unfortunately for you, your modified adjusted gross income is about $7,400 over the beginning of that phase out, over that $150,000. So your deduction is actually going to be reduced by $888, totaling $11,112. I hope you're following along because it's going to get interesting here. But so your taxable income now is going to drop to $110,788. And now don't forget, you were telling me how you're going to have to buy a new car soon. That new SUV you're planning to buy next July. Well, maybe you're planning to buy it because you're going to do road trips with the grandkids. Or maybe you just need a reliable vehicle that's fuel efficient. So let's say you finance part of that purchase and your loan interest for 2026 total around $10,400. Now, the 2026 tax reform reinstated a vehicle loan interest deduction up to $10,000 for new qualifying vehicles. And you're well below the income phase-out thresholds, which don't start until $200,000 of modified adjusted gross income for married couples. So add $10,000 in vehicle interest deduction, and your taxable income now drops to $100,788. See how we're just kind of chipping away at this? Now, you're also telling me how you're terribly inclined. Maybe you increase your gifting to your church, maybe you support a scholarship fund, or just donate to your local nonprofit. Whatever it might be, let's say you plan to give cash contributions that'll total about $2,000 in 2026. Well, that charitable cash deduction is now deductible with the standard deduction. So that brings your taxable income down to $98,788. Now, you might be thinking, but wait, Sean, what about all that talk of IRMA surcharges, Social Security taxes, and everything like that if you're pulling over $219,000 of income? Well, we'll get to that in a minute. But first, we need to talk about the magic number that's going to make all this work. So here's what just happened, right? All of your ordinary income and even a tiny slice of your capital gains gets completely wiped out by your deductions. What's left as taxable income is made up entirely of your long-term capital gains from selling that $161,000 worth of your tech stocks. And for 2026, Congress has expanded the 0% capital gains bracket for married couples to exactly $98,900 of taxable income. It's almost like I planned this before recording this video. So your $98,788 in capital gains, it's going to be taxed at 0%. So your federal income tax owed is going to be $0. So what did you do? You pulled $219,500 of cash into your life. You had $157,400 show up as income on your tax return. You ended up with $98,788 of taxable income, all of which is long-term capital gain and being taxed at 0%. So you owe $0 in federal income tax. But wait, what about those tax tripwires you talk about? Surely those are going to have to play in somehow here. Maybe some hidden tax or surcharge that's going to ruin the strategy and overall the plan for this year's taxes. Well, let's check every possible landmine. First, you have the net investment income tax or NIT, that 3.8% surtax on the lesser of your net investment income or your AGI. It only applies to your modified adjusted gross income if it's going to exceed $250,000 for married couples. And you're at $157,400, so you're in the clear. Second, and this matters since you are on Medicare, since you're over the age of 65, you have those pesky IRMA surcharges. Now, your 2026 income is going to determine your 2028 Medicare Part B and D premiums. But IRMA doesn't kick in until at least $218,000 for your modified adjusted gross income for joint filers. At $157,400, you won't trigger the surcharges, even though you actually withdrew $219,500, right? Pretty interesting stuff, I know. Third, do you lose any of those deductions that we just talked about at this income level? Well, first, the senior deduction phases out above $158,000 for your modified adjusted gross income, which we talked about. And since you're at $157,400, you do lose a few $100s, like we said, but the vehicle interest deduction doesn't phase out until $200,000. So you're going to get the full $10,000 there, and you're going to get the $2,000 for your cash charitable contributions. So you have no NIT, no IRMA bracket surcharges, and aside from a small haircut on your senior deduction, none of your key deductions are being phased out either. So you have $157,400 of income on your tax return, $98,788 of it is taxable income, and again, zero federal income tax liability, while having turned $161,000 of tech stocks into cash and pulling $219,500 into your life. Now, as you can imagine, this isn't something that just accidentally happens. You need to have several pieces aligned. So the first piece is going to be your age. You're going to need to be 65 or older to qualify for both the 65 and older additional standard deduction, as you can imagine, and the enhanced deduction for seniors. So that's up to $15,300 in extra deductions right there. Second is going to be your investment timing. Those capital gains are going to need to be long-term. You've held the investments for more than a year because short-term gains are taxed as ordinary income and they wouldn't qualify for that 0% rate. Third is going to be your income management. You need to carefully manage your earned income. And I know in real life, this is a little bit more tricky than in a scenario on YouTube, but if you have too little income, you might just be leaving money on the table. And of course, if you have too much, it's going to push your taxable income above that 0% capital gains threshold. So in this scenario, keeping ordinary income right around the $58,000 mark created the perfect balance for our couple. Fourth is going to be the vehicle purchase, right? This is going to require a 2026 purchase of a qualifying brand new vehicle with a loan. Now, the interest deduction is real money that you're paying out of your pocket, but it's money that you probably would have been spending anyways because you needed a vehicle. The tax benefit is just a bonus. And fifth is going to be your charitable giving. The $2,000 in cash contributions is kind of the final piece of the puzzle that gets your deductions exactly where they need to be. And here's the beautiful part. You're supporting the causes that you care about while also optimizing your tax situation. So look at what you've really done here, right? One, you're holding investments for 15 plus years. That's genuine long-term thinking, not just short-term speculation. 2, this year, you're finally selling some of those investments for $161,000 out of your portfolio. You're buying a fuel-efficient vehicle because you need reliable transportation. 4th, you're giving money to a charity because you want to support that charity and the community around you. And 5th, you're probably doing part-time work, maybe for the money, but probably more so just to stay engaged and to have a sense of purpose and structure during your retirement years. And the reason I frame it like that is because you're not twisting your life into weird shapes just to try to avoid taxes, right? You're living normally and you're just using the tax rules as they're written. The 0% capital gains rate, well, that's designed to reward patient long-term investors like yourself. The senior deduction, well, that acknowledges the fixed income reality of retirement. The vehicle interest deduction, well, that's Congress encouraging energy efficiency. and supporting the auto industry. The charitable deduction, well, that promotes civic engagement and philanthropy, as you can imagine. So when you align your financial life with these policy goals, remarkable things can really happen. Now, full disclosure, this exact scenario won't work for everyone, as you can imagine. If your income is significantly higher, you're going to blow past the 0% capital gains bracket. If you're younger than 65, like we said, you're going to lose those senior deductions. If you don't have long-term capital gains to realize, then the strategy might not apply at all. And if you don't need a new vehicle, forcing a purchase of a new vehicle just to get a deduction really makes no sense. But here's what I want you to understand, right? Here's the takeaway. This isn't about replicating this exact scenario for you. It's about understanding that the tax code is full of gears and levers. Most people look at their income and just passively accept whatever tax bill results they're going to get. They don't realize how much engineering is really possible when you put your mind to it. It's legal, ethical engineering that we're talking about, of course, that simply requires understanding how the different pieces of your tax life fit together. Maybe your version isn't zero taxes on $219,500. Maybe it's just minimizing taxes on $200,000, or maybe $50,000 or $500,000, whatever the number might be. The principle remains the same. Understanding the brackets, maximizing your deductions, timing your income strategically, and aligning your financial decisions with the incentives that Congress creates. So if you're 65 and older, and maybe you're sitting on appreciated long-term investments, here's what you can do. First, calculate your current income and project what it might be for 2026. Make sure you include all sources, right? Wages, self-employment income, do you have pensions, the leaky investment income that can have an effect on things. Second is going to be to identify all of your available deductions. So you're going to start with the standard deduction, just like we did in this example, or maybe look at itemizing if that's going to make more sense for your situation, and then add back in the age-based additions if you're going to qualify, like the over 65 and the senior enhanced deduction. You can also look if you're going to have the vehicle loan interest, tip wages, different things like that you can add in to figure out how can we legally deduct as much as we can on our 1040. Third is going to be to calculate your potential capital gains. What investments do you have that's appreciated in a taxable account? How much gain would you realize if you sold those investments? Now, remember, this only really worked because the investments were long-term capital gains, assets held for more than a year. And pay attention to your cost basis in this account within your investments. Only gains above what you paid is taxable, right? You have your cost basis and then your taxable gain. Fourth is going to be to do the math. Your goal would be to get your taxable income at or below $98,900 for married filing joint. And you can work backwards from that number to figure out how much income can you actually realize based on the deductions that you can claim to get into the zero and stay within the 0% tax bracket. And one little caveat, although that's kind of the goal and the focus for this video, it might not make sense for you to stay within the 0% tax bracket. A lot of times when you're in that smaller tax bracket, you might want to take advantage of the 10% or even the 12% bracket. So just a little caveat there. And then fifth is, of course, to run this by qualified tax professionals before executing anything. Every person's situation is different, and it's going to have different nuances. State taxes play a role. Maybe you might be exposed to alternative minimum tax, AMT considerations. What are going to be your future income needs? Are there any estate planning implications that you need to think about as well? So, what I'm showing you is the federal framework, but your specific application needs are going to have to be reviewed by a CPA and your advisor. Now, I've seen two types of people, right? Those who passively accept their tax bills and those who actively engineer it. Now, the difference isn't about being aggressive or pushing boundaries legally. It's about being informed and strategic. And that's the intent of this video and all the other videos I put out. Now, the tax code isn't a mystery. It's a set of rules. And like any game with rules, you can learn to play it well. Congress creates incentives for behaviors they want to encourage. Long-term investing, charitable giving, energy efficiency, maybe some part-time work in retirement, whatever it might be. When you understand the incentives that they're trying to put forward, you can start to design your tax picture instead of just reacting to it. If this type of focus on strategic tax planning is something that you think your family or just you would benefit from leading up to and during retirement, I'd highly encourage you to click the link in the description or just scan the QR code on the screen to book a call with our team. I really appreciate you watching. I hope you found value in today's video, and I'll see you in the next one.